Good morning, everyone. My name's Ed Wilson. I'm with Husch Blackwell here in Kansas City. So my practice is primarily in the M&A and transactional area. So this is my 20th year of practice. I work mostly with funds, high net worth individual and family offices doing transactions. Most of those are minority equity investments, but a lot of those are buyouts as well. So also have worked with technology and other companies working on, kind of outside general counsel work and helping them take on investments. So I've worked on both sides of the transaction for a long time. So I'm going to generally talk about kind of capital raising and from a legal perspective, getting in the best position to raise capital for your company. So, one of the things, I don't know, how many people in the audience have raised capital for a company before? Okay, so a good chunk. I think one thing I've noticed in every single deal, it takes a lot longer than you think it's going to take. It's not something where you're going to get a call, someone's going to have a deal for you, and you're going to be with a full bank account in 3 or 4 weeks. These things can take, months to get done from start to finish. So I think one of the things to think about to help make that as smooth as possible, as painless as possible, and as quick as possible is to have your company ready for taking on that investment. When these funds or these investors come to you, they're going to be looking for a handful of things that are important to them. And so having those things in line is really helpful and will make your capital raise a lot smoother. So I think just a handful of points on kind of basic legal housekeeping. So again, some of these are awfully basic for some, but very important when those investors are in doing diligence. So one is your equity ownership and your cap table. So, being able to show a spreadsheet to show who owns what is great, but having the clear backup documentation for that is extremely important. So what you don't want is a cap table that has names, but no documentation to really tie to that. So, we talked to this employee about giving them some equity. This investor came in, we're going to work it out later. That just creates so much consternation on the side of your investors that they don't have a clear picture of who owns the company. I think the other thing to think about is when you're at an early stage, giving out a couple percent here and there doesn't seem like that big of a deal. 2, 3, 4% of your $10,000 you've thrown into this company is not a big deal. But when you get to 2, 3, 4, 5% and it's a $100 million company, it's a big deal. So be very deliberate about how much equity you're giving out to people. It's something that, along with a clean cap table, it also will help you keep a lot of your value going forward. Next sorry, go ahead. Right. Yeah, that's a good point. So whether it's an LLC or corporation, I always suggest you're talking shares or units, because when you go into percent, that's a great point, and we'll talk about that. I was going to talk about that with employees, but when you give someone 5%, well, what does that mean? Is that 5%? Is it not diluted? Is it 5% right now? When you're bringing in other people at the same time, all those percentages, are they all dilutive of each other? So I think it's much safer to keep track of shares and units on a go-forward basis. And please, I didn't say I don't want to talk for 30 straight minutes. Please ask questions. I'll try to see the lights are a little bright up here, but please wave a hand and I'll answer anything you've got. So next on employees, another key thing is when you start putting your team together, make sure that each and every one of those employees have signed some type of documentation with the company that covers confidentiality, assignment of any inventions or intellectual property, and restrictive covenants to the extent you want or need them. And when we're talking about restrictive covenants, we're talking about non-solicitation provisions, whether that's not soliciting the employees of the company, not soliciting customers of the company, and in some cases, non-competition clauses. So non-competition can be tough with certain employees. Courts don't like to enforce those. They don't like to stop people from working, but at least trying to lock up that they're not going to go, that your employees can't leave and go steal your employees, go take your customers is a very key thing. And then on the intellectual property as well. So if you have a company, not every company is a high-tech company with trade secrets on their intellectual property. But some states out there, Kansas is one of them, that has very particular laws. When you have an employee, not every single idea in their head is going to go to your company and be owned by your company. So you need to have very specific disclosure that's in Kansas statutes that says exactly what rights go to the company and what rights are reserved to the employee. So make sure that's something that you've talked to legal counsel with or you're awfully confident works in your documents. So combining the first two, one of the trickiest areas is employee equity. That's oftentimes in an offer letter. And this goes to the percent question. Hey, we're going to bring you in as the CTO, and you're going to get 5% of the company. Well, that's in an offer letter that I've seen that not documented 1,000 times. And the issues that creates are voluminous. I mean, you've got issues with, okay, is it 5% now? Is it 5% forever? Did it ever vest? If that employee leaves 2 months later, do they still have 5% of the company? So those are the easiest ones to not document and to push down the road and kind of kick the can. But those seem to be the ones that are the most trouble. So really being careful about employee equity. I'd suggest don't ever promise either orally or put into an offer letter, basic terms of equity until you've locked down an actual document that has vesting and has buyback provisions. So everyone generally comfortable with the vesting. I mean, we're talking, there are a million different ways to do it at different iterations, and you can even do it with your founders. There's no reason that 2 or 3 people founding a company couldn't say, okay, we're all in this together right now, and we've all got 33% of the company. But if someone leaves and stops working for the company, those shares shouldn't be necessarily, they shouldn't still have 1/3 of the company. So, giving a lot of thought to how equity will vest with employees is an important first step. So next, IP ownership. I talked a little bit about it from the employee side, making sure that whatever an employee is creating is owned by and held by the company. Same goes for outside parties. So you may not have a full tech team internally in your startup to be able to create all the intellectual property and all the software and all the infrastructure you need. So if you need to go to outside parties, make sure that those agreements with those outside parties have you owning the technology. Again, seen plenty of agreements where it's not clear. Maybe the contractor didn't assign it to you at all. Maybe the contractor keeps rights to your technology. If you don't fully pay or there's a dispute about the payment, maybe the contractor gets to keep the technology. So there are a lot of things to be very careful about when it comes to your intellectual property. Again, much more important for tech companies, but important for all companies. Okay, any questions? I hit on some high-level topics. Go ahead.
So if a PR firm's way out of our budget, but they like our startup and they're willing to work for some equity, how is that? I mean, I think it aligns incentives pretty well because they're going to try to increase the value of the company, but how have you seen that done well or not well?
Yeah, that goes back to the issue around giving away too much of the company at early stage. I get that at that time, $5,000, $10,000, $15,000 is a ton of money, but the problem is, so is 5, 10%, or even 2 or 3% of that eventual $100 million company. So you really just have to balance, getting service providers in the cap table always seems to be a tricky item, and it's always dilutive. So my advice is, again, this is easy for me because it's not my money, but to the extent you can find any way to come up with that money to pay a service provider, it lets you keep your equity going forward. You can do things to minimize it, to dilute their equity over time, but your best bet is trying to scrape together the funds on those service providers. Okay, so the one other just kind of basic legal housekeeping item that I think, when we're diligencing a company, is related party transactions. So we oftentimes will see, family members involved in the business. Is it, a father-in-law with a loan? Is it your IP was created by a cousin? These types of things, they aren't necessarily wrong, and sometimes when you're a new company and you need to get whatever resources you can, those types of transactions are totally fine, but they will spook outside investors a little. So again, making sure those look like market terms and look like arm's length terms is really important. So again, those are not, non-starters, but be very careful about the related party transactions. Okay, any other kind of basic legal items anyone has? If not, I'll kind of go on to some other basic capital raising issues. Okay, so next, some of the earlier speakers have talked about it, but one of the most important things when you're coming up against a capital raise is having good advisors. So that's not just a lawyer or accountants. That's some type of mentor or someone that has done this before. And I think it was mentioned in the first presentation, these kind of networking events are the places to find those types of advisors. As a young person starting up a company, you're not going to know how to value your company, most likely. You're not going to know how to think about offers for investments in your company. So having someone you can go to is invaluable. When that first investor comes to you and says, hey, we think your company's great, we've heard about you, we'd like to make an investment, we're valuing your company at $6 million. Well, how do you determine whether that's a good offer? There are metrics out there, and everyone can do a Google search and figure out, well, I'm pre-revenue, here's how you think about it. I've got just revenue, here's how I think about it. I've got EBITDA, here's how I think about it. But in reality, it's good to have sounding boards on those types of issues. And they also may advise you, hey, I would tell you now's not the right time. Keep bootstrapping this company. That valuation's way too low for what you're creating and where you are in the process. So don't take capital now. Try to make it a few more weeks, months, years, and then your valuation's going to be $20 million. So having those advisors out there is really helpful. So the other thing is looking for the right money. So not everyone's going to be lucky enough to have 7 private equity firms come to them or 7 venture capital firms all sending you term sheets, and then you get to interview those potential investors. But even if it's just one party or 2 parties that become interested in your company and want to make an investment, make sure they're the right capital. I mean, a lot of different companies can write you a check and can invest in your company, but how are they going to help you? How are they going to, are they truly going to partner with you, or are they just going to give you some money and this is one of their 200 passive investments? So that not only goes for the funds, but that goes for the high net worths. The person that says, hey, here's who we should be introducing you to, here's who you should be thinking about meeting, that's the kind of people I would think you want to partner with as opposed to just dollars. So not all dollars are equal on that front. So, one other thing to think about is what? I'm sorry, go ahead.
Like I've spoken to a couple different people, and some people just are like, yes, I'll give you the money, and then there's others who will give you the money, but I want to be actively involved and I want to be like partner.
Right.
And so, it's like which is the better way, because it's like I don't want that voice to be part of the story or the snake to get you the money, but then
Yeah, and that kind of bleeds in a little bit to the next point, which is building a team. And so those kind of voices, do you want that person as part of your team? Do you want them as just an advisor that you'll listen to when they have advice, but you don't want them on the board? That is a constant battle, and that's a whole nother conversation about when you sell someone equity, when you issue them equity, what kind of rights you're going to give them in your company. And that's just a constant battle. Again, I think you need to be comfortable with that person. That goes to the question of, is it the right capital? Well, providing introductions and helping give us advice and being a sounding board is awesome. Coming in and saying, well, you're doing okay, but I'm going to run your company. I think you just have to get the feel for where they're coming from on that front. So that's a tough decision too, is when you're taking capital. That's part of is it the right capital? Or are they going to try to take over the company in a sense and be the driving force instead of you and your team? Okay, so the last, like I said, kind of when this, just talking about what institutional and high net worth investors are looking for when they're coming to invest. Everyone's looking for a good return. Sorry, go ahead.
To leave that last topic, could you please share with us what happens when you raise capital and you have a set of objectives you're going to hit and you don't hit those targets and you run out of capital? What happens next?
Yeah, that's a great question, and that also depends on your partner a lot. So when you bring capital in, whether it's high net worth or institutional, everyone's got a plan, and you're trying to hit revenue projections, ARR projections, customer projections, and they've given you, let's say, $2 million. Well, you might have blown through those $2 million and not hit those projections. So this goes back to picking the right partner. If that's someone that understands you, is committed to your business, and you've done the right things, but for whatever reason you haven't hit the growth trajectory you were looking for, you're going to probably have to go back to that capital provider and see if there's more capital available to finish what you started. There's no magic answer to know if someone's going to be able to put up that additional capital. They may send you out to the market and go raise additional capital, but that is a conversation you have to have up front, and you also have to have 10 times during that year period or 2-year period where you're burning through capital and not hitting the numbers you thought you wanted. So I think talking to your investors, making sure you've communicated with your investors, and so that it's not a surprise that at 24 months, oh, hey, we ran out of money and we haven't made any progress. That's an awful situation to be in.
Kind of the point being that you will end up owning a lot less of your company the next time.
that could also be the case.
That was kind of the, yeah.
Yeah, I think that's very fair. The dilution just continues. If you're running through money and you've taken one round of institutional capital and they took 20%, but you're out of money and you got to give another 20 or 30%, you're right. Your slice of the pie keeps shrinking the more you raise capital. Okay, so talking a little bit about what institutional investors are looking for. Mentioned, every investor is looking for a great return and wants to hit a home run on their investment. But I think there are a couple things you can assume that everyone's looking for. One is the growth possibility. So, everyone wants that home run investment. So they want to see your company's ability to grow. And, those are things like total addressable market and how much growth is possible. So being able to articulate that to investors and being able to show what that looks like is maybe one of the most important things, at least for most of the investors I work with. Everyone wants to see that type of growth and that type of possibility. Another thing, and your question went to this, it's about the team too. So one really strong entrepreneur and founder is awesome, and that's great, and they may have great ideas, and they may be building a great company. But when investors come in, they want to hedge a little. They love that you're this great, strong personality and that you've built a great company, but they need to know there are other team members in place. One person cannot do it all. You need good sales, you need good infrastructure, you need good financing, you need good technology people. So you have to have all those types of things in place, and including board. So this goes back to the mentor question, or mentor issue, and back to having advisors. Your board is, might be the couple founders, but then who else is on that board? So investors are going to look, okay, were they thoughtful about putting people on their team? Who did they bring on? Are these industry experts, or is this their cousin who doesn't really have any great business experience but maybe ran a company a couple years ago? So having that kind of professional outside voice can be really important, and I think viewed very favorably by outside investors. Okay, any other questions? Go ahead. Yeah, so the question was, how do you think differently about acquisition versus capital raise? It really depends on what the conversation I usually have is, where is your head at as a founder? Acquisition typically connotes a large liquidity event and, maybe a shortened lifespan at the company. You're not, you might, all people are different. People can get millions of dollars and work for another 30 years just as hard as they were working the first 30 years. But what that typically means is you're changing your mindset. You're there for more transition to a more professional investor and professional company. So, that's a personal choice. It's more of a psychology question maybe than legal question about what are you thinking about? Do you want to be in that role where you're taking on a minority investor, or maybe it could even be a majority, but you're still taking a significant chunk of the company and pushing forward growth and looking for, maybe you got a little bit of liquidity in a capital raise, but typically that's not common. And so you're looking for that next exit, and you're working hard towards that next exit. So it's really depending on where the founder is in their mindset. Yeah.
Right. I mean, the potential buyer is going to want you to have employment agreements protecting the IP.
Sure. You're talking between a minority investment and an acquisition. Yeah. I mean, I think if I would guess, a minority investment would probably do 80 or 90% of the diligence that a full acquisition would do in most cases. They're still looking at most issues. They're maybe not as focused on some of the day-to-day operational things. They're going to trust the company and the management team that's in place to already do that. But diligence-wise, it's really a lot of the same work between a significant minority investment and a full acquisition. Go ahead.
As a company, deciding how global to go is a cost factor when getting your patent.
Right.
And so I was wondering whether you have any experience or have any recommendations on how to, sort of what strategies and what impact this aspect, how global, US, Europe, et cetera, how that impact is when trying to raise capital, and how strategies around that.
Yeah, my honest answer is talk to one of my IP colleagues, because it's not my perfect area of expertise. But I think the analysis you're looking at is your business already global? Is there a very high likelihood that your business is going to be global and that there's going to be a threat from overseas? It is a very expensive process. So that's part of the analysis that some experts go through. Anything else? Okay, I think that's perfect. We're out of time. Thanks, everyone.